Okay, Ali, I think we're ready to start. Then I'd like to welcome everyone on this webinar on behalf of ODI Global. Just briefly, ODI Global is a global affairs think tank, and we've set up a Center for Private Finance in development and are hugely interested in the topic that we're going to be discussing today. And it's therefore a privilege to host the launch of this report on secondary market vehicles in emerging markets and developing countries, on lessons and implications for development actors. The report has been authored by ThirdWay Partners, and Ali Breedlove and colleagues are here, and we'll hear from them later. Let me say up front that I find it an excellent report, and that I believe it's a report that will be influential in inspiring action. The report has been commissioned by MOBILIST, which is the UK government's flagship initiative with support from Norway and Switzerland to help mobilize large-scale investment flows to emerging markets and developing economies through public markets. And the MOBILIST Research and Policy Platform looks to create an evidence base to support this. This is all consistent with a broader range of UK government initiatives to bring private finance into development and climate. It is useful to take a step back there and look at the role of private finance, including long-term investment, which a few decades ago was basically not present in the development sphere. It's grown from close to nothing to now being a very substantial share of finance for emerging markets and development economies. And with the Sustainable Development Goals and the climate goals that the international community has set themselves, there's a growing realization that one has to go much further, and that public finance can't do that job. So there's considerable momentum behind this agenda of bringing private finance into development and climate finance. And a key part of this is the question of how development finance institutions that have been set up to fund long-term investments in emerging markets, developing countries, how those can help to mobilize private finance to bring it alongside. And traditionally, DFIs have been doing this for a long time, but traditionally they have employed bond funding, their own funding. They have employed syndications, B loans to do so. More recently, they have moved towards more portfolio-based approaches, securitizations. They have sold risk into the insurance markets. All that with some success. So recently, the mobilization of private finance through the development finance system has increased, and we hope that that momentum is going to continue. But looking into the future, where we must widen our lens, and the report that's being launched today should be seen in this context. There are sort of a variety of high-level issues in emerging markets and developing economies across infrastructure, real estate, private equity, and other sectors that are that have made it hard to attract primary investments. There's a lack of liquidity and exit routes that limit capital recycling at the tail end of an investment. The absence of secondary market exit routes increases the cost of capital in the primary markets. It increases perceptions of risk and overall reduces investor participation by slowing fundraising. And it would be interesting to hear a bit more about that from the report. So MOBILIST collaborated with British International Investment to commission this study, which, by the way, is the fourth piece of its market infrastructure and enabling environment research, and to look at the importance of secondary markets for increasing the pace of private investment in EMDEs. And the report demonstrates why secondary market transactions and vehicles are needed to address these issues that I've mentioned, the lack of liquidity and exit routes, the increased cost of capital, etc. And how secondary market transactions and vehicles can create credible and repeatable pathways to exit, and how the increased liquidity can lead to a virtuous cycle. So this is very timely research. There are actually early signs of market momentum in this area. DFIs and multilateral development banks are engaging more actively in this agenda. And it's particularly important in the context of the funding reductions that we are witnessing when it comes to public finance, and the need, therefore, to recycle capital more efficiently. So with this, I'm handing it over to Ali Breedlove of ThirdWay Partners, who might want to tell us very briefly about ThirdWay Partners itself, and then to take us through the report. We will have several other interventions from practitioners and investor perspectives, and then the opportunity for some questions and answers at the end before we close. So, Ali, can I hand it over to you to present the report?
Thank you so much, Hans-Peter, and thank you everyone for being here today. My name is Ali Breedlove, as Hans-Peter mentioned, from ThirdWay Partners. We are an investment and advisory firm focused on sustainable development. We're very excited to see everyone here today to launch this report, Secondary Market Vehicles in Emerging Markets and Developing Economies, Lessons and Implications for Development Actors, which was co-sponsored and contributed to by MOBILIST and BII. Hans-Peter kind of quickly went through the agenda, so we'll spend about 15 minutes discussing some of the highlights of the research. We'll then hear from some investors and practitioners of secondary vehicles to ground this in the kind of real world, and then finally have some time for Q&A. There should be a Q&A section in Teams, so please do send questions as they come up throughout the session, and we will save them up for the end in the Q&A session. So Hans-Peter covered the market context very well, so I won't spend a lot of time here, but we talked a bit about the frictions that are faced in primary markets and EMDEs, the limited exit pathways, misalignment of risk, appetite and profiles, unreliable and mistrusted valuations. This means that infrastructure developers and private equity fund managers struggle to recycle their capital, which then impacts holding periods, returns, and future fundraising in primary markets, which then in turn impacts broader development goals. By providing these predictable exit routes, secondary vehicles, which focus on acquiring assets from existing investors, can de-risk primary investments and free capital for new investments, while also creating lower risk opportunities to broaden the investor universe. This is a big opportunity for private capital mobilization by attracting institutional investors, and particularly local institutional investors, into vehicles that are lower risk and have less uncertainty. But why is this so important now? So as Hans-Peter mentioned, we are beginning to see activity emerge in EMDEs, which I'll cover in a few minutes, but it does remain underdeveloped and slow moving. In the past, development actors, and particularly DFIs, have focused on primary deployments where the impact case and additionality are often clearer. But we are seeing this focus shift and actions being taken in the market, driven by a combination of a number of factors, including very ambitious goals, for example, in infrastructure, which require a faster pace of investments, accumulation of capital in funds which are struggling to exit, particularly in Africa and South Asia, and then, as Hans-Peter mentioned, in a period where development financing is declining across many countries and needs to be stretched further. As you'd see in our report, we found that intervention is needed to support the development of secondary market vehicles. And it is no longer a question of whether to engage, but how to engage and how quickly to engage. The report examines secondary vehicles in EMDEs and also in some developed markets where lessons can be learned through a number of case studies, as well as interviews with a range of industry experts. We won't go into a lot of details here today, but we will touch on a couple of key points. One thing that I will say before I get into some of these vehicles to start with is that we did not include securitizations in this research, though we recognize that they are very important and that they are seeing traction. They have been covered already quite extensively and are being covered extensively, so we have not included them here. Within infrastructure and real estate, there are some strong success stories in EMDEs. For example, infrastructure investment trusts, INVITs, have emerged in India and led to faster capital recycling and a lower cost of capital, while also supporting faster infrastructure growth in the country. Within yieldcos, the report examines lessons from the US in the 2010s, where faster exits and higher valuations were seen through the presence of standing buyers. But it also looks at South Africa, and we'll hear more from Rovigo later on their experience there. And finally, real estate investment trusts, REITs, helped to lower financing costs and deepen financial markets in Mexico, while Kenya provides a case study on adapting the structure to African contexts. Within private equity, unlisted secondary vehicles have emerged to varying degrees across regions. And where they have emerged, they've improved liquidity, broadened investor participation, and enabled capital recycling. For example, in Latin America, secondaries volumes have increased and provided exposure to mature portfolios to a diverse group of investors, including pension funds and family offices. In India, the market has continued to deepen with the presence of global and local secondaries investors, and we'll hear more from Stratford House later about their advisory and fund work in this market. In Africa, there are some initial signs of growth with funds like Sango Capital and Meta Secondaries, but the market continues to face structural and execution constraints. Finally, we also looked at listed vehicles for private equity assets, including opportunities to list these structures on developed market exchanges. For example, in London, through the investment trust structure. As part of this, we also considered opportunities to replicate structures like this in EMDEs in the medium to longer term and touch on a few examples where some of these vehicles are already in the works. Through these case studies and interviews, we examined the supply, demand, and system enablers, which have supported the emergence and the scale of secondary vehicles, though these really should be viewed as a virtuous cycle. The growth of secondary vehicles supports and reinforces the strengthening of these enabling environment factors. I'll just touch on a couple of examples where these conditions have been particularly supportive in developing secondary vehicles. So looking at asset supply, INVITs in India benefited from a stock of operational assets, while the expansion of REITs in Mexico followed a big real estate boom. In private equity, secondaries markets in Brazil benefited from mature portfolios that pension funds were looking to sell over the last decade. Looking at demand and investor depth, the presence of domestic institutional investors can support growth, which we've seen in Latin America, India, and elsewhere. But as I mentioned, it is a virtuous cycle, and the introduction of these vehicles has also brought these investors into the alternative markets by providing lower risk and less uncertainty in the vehicles. And finally, looking at the system enablers, intermediaries and specialist managers have supported transactions, for example, local platforms in Latin America and in India. Credible regulation and policy has played an important role in the expansion and uptakes of vehicles. For example, regulatory changes in Kenya supported the REIT market development. Price transparency and disclosure has provided confidence to markets to enable further growth. And finally, as across all financial cases, the macro and geopolitical stability play an important role in supporting, or in some cases inhibiting, vehicle growth. I'll next just touch on some lessons learned and implications, first in infrastructure and real estate, and then in private equity in a moment. Within asset supply, unsurprisingly, aggregation is needed for scale, and this can be a challenge in many smaller markets, for example, in Africa, where there might not be sufficient scale in the individual market. And so this might initially be somewhat limiting for vehicles to be in larger markets. There is an opportunity to explore the potential for regional structures and regional aggregation. Within system enablers, clear and active regulation is needed to reduce friction. For example, in India, the regulator was very reactive to market needs while also providing detailed and predictable rules to help to offset structural challenges in the market and really enable the growth of InvITs. Strong governance and simple channels to investment can mobilize both institutional and retail investors. For example, in Mexico, in REITs, these investors entered the market once frameworks and benchmarks had been developed. And finally, as in primary vehicles, the integration of currency risk management is critical. Many of these vehicles are local currency instruments that are backed by local currency revenues. And so this risk is lower for local investors, making the vehicles quite attractive. But the risk does need to be managed to attract international investors and development finance actors. Looking towards private equity, many of these same lessons apply. So touching on a few additional details here. DFI intervention can have a significant impact on market development, particularly in more challenging contexts. And they have a key role to play and can and should participate on both the buy and the sell side of the market to catalyze market creation in this space. Historically, there has been a limited acceptance of discounts and liquidations, which keeps capital trapped in funds and in vehicles where there might be a better opportunity to recycle that capital into new investments that might be higher return and more impactful. Looking at the demand enablers, large pools of institutional capital attracted anchored secondaries markets in OECD countries and in Latin America, but allocations to alternatives remain low in many other markets. Support is needed to bring these investors into the market, for example, supporting education, backing purpose-built vehicles, etc. In looking at system enablers, specialist intermediaries are essential to structure deals, find buyers, and unlock residual value in aging portfolios. And particularly having specialist intermediaries with strong knowledge of the countries and regions in which they're operating. Finally, transparency and credible valuation frameworks are critical for growth. For example, in Latin America, regulatory clarity reduced the friction significantly and helped the markets take off after some initial challenges around valuations and discounts, which slowed the market growth. So now we'll come to some recommendations for development actors. So we split these across 3 timeframes: an enabling recommendation to shift mandates and incentives, short-term recommendation around portfolio management, and finally, longer-term recommendations to help build a sustainable market. First, mandates and incentives need to expand. For example, this could be by recognizing secondary market creation as a development outcome on its own without the need to make other impact or additionality arguments, which would allow DFIs to act as both sellers and selective buyers. Then incentives need to be aligned to these mandates to actually enable this change to happen. For example, this could be through incorporating capital recycling into scorecards, increasing the importance of improving liquidity, etc. And while we are seeing this shift happening and different DFIs are at different points in this process, there is a need to speed up the shift to help these markets really take off. In the short term, secondary vehicles can be a good tool for portfolio management, particularly, though not only, in private equity. In some cases, this will require DFIs and other LPs to accept liquidations and discounts to the valuations that they might be holding in their books. However, as I mentioned, there is an opportunity cost to continue to hold these assets. And of course, this would need to be viewed on a case-by-case basis to understand the best options available. However, even in the short term, the focus should be on selling both performing assets and non-performing assets to start to create a better functioning market in the medium to longer term and to begin to establish price benchmarks. Finally, development actors can take longer-term market-building actions. They can support purpose-built vehicles. So for example, in infrastructure, backing InvIT or YieldCo-like vehicles in new markets or backing their growth in existing markets. They can help to build execution capacity and promote enabling policy. For example, through supporting intermediaries, helping to cover costs, where regulatory changes might be needed for first movers who then are incurring those costs, and working directly with regulators and industry associations to provide support to ensure that policies and regulations are in place and work well in the markets. They can help to expand participation and mobilize capital through a range of actions. For example, they can consider providing downside protection to provide comfort to less risk-tolerant investors. And in some cases, even the presence of a DFI alone is sufficient to attract new investors into the market. They can ensure that structures are simple enough to attract these investors. And they can complete demonstration deals on both the buy and the sell side. But these deals do need to be transparent to enable, for example, the development of credible price references. Particularly in private equity, DFIs can structure primary investments to make it easier to exit, for example, by embedding transfer rights into initial agreements. And finally, as across primary markets and other markets, there is a need to take actions to support instruments which can help to mitigate broader risks that impact capital markets more generally. As mentioned at the start, there is a need and interest in an understanding that secondary market vehicles are critical for market development and growth. And we hope that through this research and bringing together key decision makers for conversations, we can continue to shift markets more quickly and help to build secondary market vehicles in EMDEs. So I will now start to hand it over to some of the guest speakers that we have today to hear from investors and practitioners to help to really ground this research in real world experience. So I will start with Reem Daoud, an investment director in infrastructure and climate at BII, and ask her to share some perspectives on BII investment in secondary vehicles and infrastructure, including Revigo, and opportunities being explored outside of South Africa. Thank you.
Thanks, Ali. Hi, everyone. Pleasure to be here. As Ali mentioned, we've been looking closely at the secondary market for renewable energy assets in Africa for quite some time. DFIs, or development finance institutions, have traditionally focused on primary greenfield investments because that's where new capacity and new impact are created. But we're increasingly convinced that a healthy secondary market is just as essential for the sector's long-term growth. In a well-functioning power market, early-stage developers recycle capital by selling operating assets to lower-risk institutional investors, and that recycling is what fuels the next wave of greenfield development. In much of sub-Saharan Africa, that mechanism is still missing. Outside of a handful of iconic projects, operating renewable IPPs have struggled to attract buyers. And so the stalling in exits has resulted in the stalling of reinvestments. Developers' appetite for new projects shrinks, and the flow of private capital needed to close the energy deficit in Africa slows down. We also see secondaries as a way to bring new domestic investors into the sector. So pension funds, sovereign wealth funds, corporates who may not be able to take greenfield risk, but can probably invest in de-risked operating assets with long-term contracts and predictable cash yields. A functioning secondary market gives them an entry point into an asset class that they've historically not had access to. Our investment in Revigo, for example, and Ziad will speak more to that, is how we saw this working in practice. So by supporting a dedicated vehicle with a portfolio of operating renewable projects, we're helping create liquidity that allows ownership to then transition from developers to long-term institutional holders. And that transition is what frees up capital to be recycled into new greenfield opportunities. And we also think it helps scale the asset class that can then mobilize institutional capital at a pace and scale that the South Africa's energy sector requires. Ali's, and to Ali's second point, we're now looking beyond South Africa. Over the past decade, Sub-Saharan Africa has built a meaningful base of privately developed renewable energy projects, operating cash-yielding assets backed by long-term PPAs. Many were developed by fund managers who are now reaching the end of their fund lives and need to exit. But without a deep and reliable secondary market, those exits have been extremely difficult, and that has constrained funds and investors' ability to reinvest in the next generation of greenfield projects. And this is why I think we need to ensure that developers can exit, capital can recycle, and institutional investors have a credible pathway into the sector. Thanks, Ali.
Thank you very much, Reem. I'm sure that we'll have some questions for you in a moment. Next up, we have Dave Portman on the product platform team at MOBILIST to share some perspectives on private capital mobilization in secondary vehicles. Dave, over to you.
Thank you, Ali. Yes, I'm on the product platform team, which is to say I'm not part of the policy platform colleagues who commissioned this research, so I cannot take any credit for this excellent report, but I can at least endorse it. As we heard from Hans Peter at the top, MOBILIST is an FCDO program, and we're focused explicitly on public markets. So in a nutshell, our mission is to support listed products in key markets that we feel have the ability to channel private institutional capital into development assets. We do this broadly across the landscape of development finance, but through our equity capital and TA offerings, we have worked with several initiatives relevant to the report we're discussing today. So these include a number of investment trust type structures, which again, as the report discusses, are a natural home for secondaries vehicles. And more specifically, we provided direct support to initiatives put forward by the likes of Rovigo, Gaia Fund Managers, October, among others. Now, Ali, you asked specifically about private capital mobilization, and we do indeed grapple principally with this important question in all of our engagements. It's essentially the raison d'etre of why MOBILIST was created. So I'll try to offer just a few reflections on this, specifically as it relates to secondaries vehicles, although many of these learnings I think do apply across structures and approaches. The first point I'll make relates to the availability of assets. In 2019, 18 East, the consulting firm of which I'm a partner, we wrote a report for the then brand new MOBILIST program entitled The Exit Mobilization Opportunity in Africa, I think it was called. And we very broadly found two things. On the one hand, there are extensive DFI holdings that at least conceptually can be attractive to private investors. This was sense checked against a variety of data sets and also qualitative interviews with investors. And I think this is an assertion that is further stood up by the reports, among other reports, that Rovigo did with MOBILIST support on the renewable sector. And then the other thing, or the other finding, a very high level finding, is that there are established product structures, many of which you've highlighted in your report, and most of which are available on listed markets, that are sort of understood and can create, again, conceptually, the conditions for DFI exits and for secondary sales more broadly. Now, the challenges involved in DFIs shifting from buy and hold to originate to share approaches are indeed worthy and numerous, but nonetheless, these institutions undoubtedly have a key role to play in assisting the secondary market in Africa, anyway, to develop, even if, as the report suggests, just as or in the first instance as willing sellers of performing assets. Another key consideration when it comes to private capital mobilization is the difference between, or understanding the difference between domestic and global institutional allocators. In the case of Kenyan or Nigerian markets, for example, we very rarely encounter global private investors, and I'm talking institutional level here, keen on materially investing in real or developmental assets, irrespective of how they're structured. We do, however, see significant appetite and growing appetite on the part of local institutional investors, pension funds and insurance companies in particular, to diverse away from their over-indexed holdings in government securities and to gain exposure to the growth assets that, for regulatory and other reasons, are largely inaccessible to them when held in the private markets. MOBILIST's investment alongside a cohort of domestic pension funds in the listing of InfraCredit in Nigeria and our subsequent exit to a further additional group of pension funds after about 18 months, I think it was holding, is a testament to this one example, but this is what MOBILIST is here to do, to try and create examples. Again, given that in the context of Africa, many such assets are majority held by DFIs and MDBs, there's a clear, at least high-level imperative for greater level of secondary sales. To maybe briefly highlight a secondary specific example, the Gaia fund managers have recognized this local investor dynamic and have created, an ambitious fund structure that relies on the listing of multiple feeder funds on several African exchanges. These are designed specifically to tap into and attract and be accessible to these domestic institutional investors I've just briefly outlined, and to bring them into their renewables secondary fund. MOBILIST is very pleased to be providing technical assistance support to the structuring of this vehicle. Now, MOBILIST is a very small team, and what we've sought to do from the outset is leverage existing capital market infrastructure to help us both originate opportunities, but also to understand investor demand. So in this regard, we work with stock exchanges, investment banks, brokers in key markets. In the context of secondaries, this intermediation as a catch-all term can be thought of as being crucial at two levels. First, capital formation into new secondaries vehicles, of course. I'll touch on that perhaps in a second, but also to facilitate the secondary asset sales themselves, be it through the design of dedicated vehicles, as the report looks at, or even the application of matchmaking expertise. This is perhaps a degraded but incredibly important part of any functioning financial market, as is the generation of better price performance and risk data sets around assets held in the private market. Our experience in Africa, at least, is that banks and brokers are only now coming to understand the opportunities inherent in development assets. So from MOBILIST's perspective, we hope that by helping to bring new listed vehicles to public exchanges, we will encourage more investment in local intermediation capabilities, and of course, then the knock-on virtuous effects of market development. Now, you'll have to forgive me the African context of my remarks. I live in Cape Town. Africa is where I focus for MOBILIST. But I will also say that understanding market context is essential. MOBILIST is active across all ODA markets. So when contemplating the listing of a secondaries vehicle in, let's say, the US or the UK or a larger Asian economy, there are much deeper and more liquid capital markets than what we see across most of Africa, perhaps outside of South Africa. And these markets are also much more thoroughly intermediated with wider investor coverage, deeper levels of understanding, and so on. So as one contrasting example, while there are many people in Kenya, as you alluded to, Ali, working very hard to create an active REIT market through supportive regulation, tweaks to the listing rules, the reality today is that products coming to market still require significant amounts of anchor capital, as well as the reputational advantages that can be provided by high-level or high-profile development investors. This means we collectively do need to support such products, even or perhaps especially if they are to be listed. Doing so can, MOBILIST believes, help create functioning and robust markets that can bring private capital into secondaries vehicles and other product structures that is both systemic and eventually also done at scale. I'm sure I'm over my time already. 5 minutes is a very small window to say anything substantive, but I do hope some of these disparate reflections have been of interest. Thank you very much.
Thank you very much, Dave. Next up, we have Ziad Sarang, the Chief Investment Officer of Rovigo, to share more about Rovigo's story, lessons and constraints, and support needed from development actors. So over to you, Ziad.
Thank you very much, Ali. I believe I've got 10 minutes, but that has been substantially reduced. So I'm going to try and reduce my speech as well. We love telling our story. My name is Ziad Sarang. I am the Chief Investment Officer of Rovigo Fund Managers. We are a South African-based fund manager in Johannesburg. We've got 10 assets under management to the value of about $180 million and we ran funds, so I'm just quoting dollars because of the international audience. What we do is we focus on renewable energy assets only, so very niche mandate, but more specifically and more relevant is that we focus on operating renewable energy assets in sub-Saharan Africa. We invest in equity in those investors, and the gap that we seek to fill is to provide a vehicle such that we can attract long-term institutional capital and provide them with an entry point into investments in renewable energy and infrastructure, but but more importantly, provide for the exits of investments from early stage investors, such as PE funds, private equity funds in those renewable energy assets, as well as developers who want to churn their capital. So from that perspective, we are very focused on the secondary market. We understand the difficulties that was spoken to you about by Reem as well as Hans Peter, as well as what we find on a day-to-day basis. When we are pounding the streets currently in the 5-year life that we are running this yieldco, is that education plays a very important part, particularly with investors, particularly with institutional investors. One, within the South African context, and the African context for that matter, long-term infrastructure investment is not fully understood by institutional investors. So what you have is a situation where you're spending a lot of time educating the institutional investors on what this particular asset class is about, and more difficult for us within the secondary market, or focusing on the secondary market, is explaining secondary market investments is a long-term hold, and the returns that you get from these investments are actually risk-adjusted investments, not typical private equity investments. Why? Because as Rovigo and as a yieldco, we are the exit. We don't exit investments. We are the exit. So when we are raising capital, when we are looking to raise capital, the institutional investors particularly ask the question of what is my exit, and that is something that needs a lot of education. However, what we found was, and this was very early on when we started this journey, being an open-ended investment vehicle in 2021, we attempted a listing on the Johannesburg Stock Exchange. And the very first thing we found out during that exercise was that scale matters. Institutional investors, whilst they still need to be educated around or need education around this investment class, what they're looking for is scale. And very quickly we realized that we're not going to get that scale from the institutional market only. We need partners such as the DFIs, the developing finance institutions, to come along with us to get the scale and crowd in the institutional investors. And from that perspective, we hit another hurdle in that, and Ali made this point earlier, and Hans Peter as well. Development financing institutions mandates do not allow currently do not allow for secondary. I need to check my words there, for secondary investments, because up until now we still struggle with any DFI other than BII, who has put in a substantial amount of capital into Rovigo in the last month. The role of DFIs becomes critical for us to scale up and attract those institutional funders, because it provides a basis where you can not only list the funds such as Rovigo or yieldco such as Rovigo locally, but also internationally. What we've realize also from talking to institutional investors for these secondary market assets is that they look for partners that want to invest in sustainable investments and provide a good return. Now you get that through diversification. So scale again is very important. By having a diversification across different technologies, different geographies, and as well as different developers, you get that. You get that diversification, which gives institutional investors a lot of comfort. So I take it back again to scale. And in order to get to scale, you need to have the capital. Why I say that is because the renewable energy sector in South Africa and sub-Saharan South Africa more specifically, has got an enabling environment where we've got a significant pipeline. So pipeline is actually not the issue here. To get to scale, one side of the equation is almost solved because we've got enabling environment, regulatory environment, a lot of transactions that are secondary market assets, but you've got the development capital that needs, or the investment capital that needs to come in and unlock this. The second part of the learnings that we've got is that with those assets and the growth of renewable energy investments in South Africa specifically, and sub-Saharan Africa generally, is that the exit market and the secondary market is not yet matured. We've got an incomplete funding cycle, and what you need is the capital to come in and allow those developers to exit so that they can churn their capital and recycle the capital back into development projects. That problem is, we're seeing it currently more specifically in sub-Saharan Africa, where you've got the trapped capital in private equity funds that are finding it a challenge to exit at a decent multiple. Within the South African context, we don't see that as a significant challenge, but it is a challenge for us to access large institutional capital and get those developers to recycle their capital back into development projects where we know that they can get a better return. And in fact, it's a bit of a chicken and egg situation, because DFIs are focused on from a mandate perspective to grow the megawatts on the grid, but also facing challenges. And Hans-Peter said that future allocations, if we look forward, are less. So how do you grow the pot? You don't just look at future allocations that are coming into new megawatts. You've got to release the trapped capital in the current projects, in the current operating projects, and get developers to do what they do best: develop projects, churn their capital out of operating projects or projects that reach operations. And with vehicles such as Revigo, where you can build up the capability to buy those assets, even structure those exits pre-financial close, so that developers know that they've got a cycle of capital that will come in, develop assets, exit, and develop assets. So this incomplete financing ecosystem is something that we believe that will allow, together with DFIs, allow institutional capital to be mobilized in a better way. And it really comes down to this being, a game of scale. From our perspective, what we've seen and what we've actually lived over the last 5 years, and is that when you have the recognition that the secondary market is a legitimate development, a legitimate development outcome, you are able to attract that capital. And BII has demonstrated that together with an investment with Alexander Forbes being a local institutional investor, that allows an increased amount of capital coming into the fund and allowing us to exit developers' existing projects, going back into their greenfield projects. From our perspective, what I would really like to see, and this is my own personal view, is that private equity for infrastructure, in my opinion, appears broken. Why do I say that? It's slightly controversial. We don't want, what I think we don't want is having the vehicle exits, or at least private equity exits, going beyond what we see currently. It started at 5 years exits, 7-year exits. We're talking now 10 and 12-year exits, and then continuation funds. What DFIs, I believe, should help the system is to allow exits or force exits sooner, so that the churn of capital can happen in a much more programmatic way, where there are vehicles, purposeful vehicles, such as Revigo and I believe Gaia as well, will allow those flows to happen in a much more programmatic and transparent way. What do we think? Do we think that this type of model, where we've got churn of capital in a market where you've got an enabling environment, lots of projects, a pipeline of projects and development that we can see happening, can that happen outside of South Africa? Absolutely. what you have is a situation where platforms are holding on to operating assets, hoping for more projects, but you need to exit those operating assets and get them back into development, and thereby increasing the financing pie. I am aware that I have reached my time, so I am going to pause there, Ali, and have a bit of discussion at the end as well. So happy to take questions then. I'll hand over to you, Ali.
Thanks very much, Ziad. Next up, we have John Owers, the Director and Head of Fund Solutions at BII, to share some perspectives on the importance of secondaries in BII's markets and what role BII is looking to play. So John, over to you.
Thanks very much, Ali, and hello, everyone. I mean, a number of colleagues have already talked about the role that secondaries can play in sort of improving capital efficiency and the recycling of capital in our markets. And we look at it within sort of the private equity space very much through that lens, but in particular as a way of trying to facilitate mobilization. And what I mean by that is in the last couple of years, what we focused on is doing LP secondaries, which a lot of which are partial exits from funds. And that creates quite a different dynamic when you're sat in front of a prospective buyer, because it means you're not exiting the fund and they take comfort from that. It also means they can diligence very clearly what they are buying. And we see this as an effective way of trying to introduce new sources of capital into our markets. It's a new relationship for the fund manager. That may or may not come with a subsequent commitment to the successor fund. But we think it helps demonstrate that a missing part of the ecosystem in our markets, can be addressed and needs to be addressed. And I think the interesting thing about secondaries as a sort of a potential mobilization tool is sort of contrasting that with all the efforts that ourselves and others have done historically to try and persuade investors, a lot of domestic investors, to come into funds that are fundraising to make primary commitments. And there, a typical stumbling block is often about an investor who may not be that used to fund investing, trying to understand what they're getting exposure to. And when you say it's a blind pool and we can show you a pipeline, but that may not be what you end up with, that's quite a difficult hurdle to surmount. So this is why we think secondaries can play a role in mobilizing, but also play a role in enhancing the liquidity in our markets. As a number of speakers have said, capital is trapped. Now, we are very much discretionary sellers. Secondaries is a normal portfolio management tool for developed market fund-of-fund investors. We're not forced sellers, and the analysis and trade-off on discount and realized IRR and the improvement in the fund DPI vis-a-vis the unrealized IRR is essential to what we do. And if we're not comfortable with it, we won't take it. But it is important to stress, therefore, as well, though, that throughout the private equity world, in all private equity funds globally, they all tail off over time. Even in the top performing buyout funds in America, you see TVPI declining towards the end of fund life. And so if you are genuinely an active investor, you should be thinking about secondaries as a portfolio management tool, as well as, and alongside, in our case, a mobilization tool. Ali, I'll leave it there. I'm keen to leave more time for questions. Thanks very much.
Thanks, John. And closing us out in these initial conversations is Piyush Jawar, a partner at Stratford House, to share some of Stratford House's story, lessons and constraints, and also views on the support needed from development actors. So over to you.
Thanks, Ali. Coming in as the last speaker, I'll try to be incremental and not repetitive. Stratford House was established by us about 5 years ago. after spending several years at BII funds business. We provide both fund-based and non-fund-based solutions to LPs and GPs active in our markets. And we realized in order to do that effectively, what was required was on-the-ground presence and a hands-on approach. So we shifted our bases from London to India and Southeast Asia. We started off with advising BII on a large part of their legacy India funds portfolio, and also the LPAC and GP of a very large old fund which had poor performance in terms of helping them with their exits from the residual portfolio. Since then, we've expanded our services to other clients and also in terms of products. So along with that, what we also do is deal by deal secondaries, and we are just in the process of raising a domestic secondary focused fund for Indian investors in India. The reason we thought that this space required this specialized focus was because tail end funds, whether they are performing or non-performing, they require a fairly active hands-on management, because in case of active fund situations, in case of performing fund situations, there are managers who at times tend to get creative with the continuation structures, and there have been instances where assets have been undervalued so that they could be moved to continuation vehicles, and therefore the managers could benefit out of that. So you have to be on top of these aspects from a governance perspective to make sure that the interest of existing LPs are not compromised while working out these solutions, whereas supporting these solutions when they are genuinely required. In case of non-performing funds, often the teams become very thin as they approach the end of their fund's life. So therefore, they require actual support in terms of finding exits from the residual portfolio companies. So there have been situations where we've actually identified buyers. We've connected fund managers to the right set of investment bankers. We've introduced funds to new sources of capital to be able to attract money for their portfolio companies. So it does require kind of a fairly hands-on approach. And what is important in these tail and portfolio management cases is to act ahead of time and not at the time when the problem has actually started. So therefore, a timely intervention is really required to get a grip of the portfolio before it kind of becomes a rather difficult situation. Because we've also seen that manager removal is not an ideal scenario, although we have had experience of doing that, but that should be seen as an absolutely nuclear situation. We've also seen that just management solutions are not enough in each and every case to be able to resolve a particular case effectively. So therefore, capital is required, and that's where secondary liquidity becomes important. In developed markets, if you see the threshold is that roughly about 10% of primary value of investment is traded in the secondary market, but in emerging markets, the number is way below that figure. Just to give a sense of the Indian market, over the last 10 years, roughly about $400 billion of private equity investment has happened. But over the same period, less than $200 billion of exits have been delivered. So there is a very large amount of stuck capital which is there, and that requires a resolution. Where the Indian market is today is essentially, while there are large global secondary players that are looking for deals in India, but there are two challenges. One is obviously they want a certain deal size, which is often hard to get in emerging markets because their deal thresholds are fairly large. And finding those kind of deals is not easy in developing or emerging markets. Second thing is they have a preference for constantly compounding well-performing assets, so leaving the difficult end of the market completely unattended. So it does require a specialized focus and a certain different level of risk appetite to be able to deal with the situations like these. Which is where we thought that there was a niche that needed to be addressed. So for the deal by deal strategy that we have, where we acquire LP stakes in the regional funds, working with certain family offices and smaller institutions who have the right amount of risk appetite to be able to take on those kind of positions, and of course with our hands-on approach, where even in case of LP stake purchases, we get fairly active with the GPs in terms of driving exits and liquidity from the residual portfolios, and on the domestic side as well, domestic capital participation has increased significantly over the last 7 to 9 years. But investors who have been early entrants in this segment, they are now starting to realize that liquidity is again not very easy to come by. And unless there is an active and vibrant secondary market, their interest will start diminishing. So therefore, there is a need to do this domestically as well. Coming on to what the development actors perhaps could look at from the perspective of market development. Essentially, I will cover three aspects separately. One on the management side, second on being the sellers of positions, and third, supporting the buying of such positions. So from a management side, I think a lot of DFIs have set up fund solutions groups, some more advanced than the others. So a concerted effort is required to kind of consolidate stakes, particularly in these difficult situations, with regional specialists, so that a more influential and meaningful intervention can be made. And as I mentioned earlier, it kind of needs to be done ahead of time and not after the problem is actually stuck, so that some ground can be prepared to resolve situations appropriately. We have explored situations like Super LP, where through advisory and acquisition of LP stake structures, we have acquired majority stakes in funds, and then we have worked actively with fund managers to drive exits, so such that the funds have progressed more in a better way, essentially, towards their winding up. Second thing, on the seller side of things, what we have seen is typically accepting discounts is not easy for any investor, particularly for institutional investor, and it becomes even more difficult if they are public institutions. But in those situations as well, if there is a independent third party that sets a price benchmark, then it becomes relatively easier for even public institutions to accept the discount and churn the liquidity and move vehicles closer towards winding up. So there, I mean, it's important that some development actors come forward and realize as to what the right pricing should be, because managers often may have tendency to hold assets at a value which is somewhat higher than what the realistic value might be. So therefore, setting a price benchmark in certain situations is important, such that it enables others also to participate in such sale processes and thereby churn liquidity. From a buyer perspective, as I mentioned, most sophisticated or developed market investors typically prefer higher quality assets, or they typically have higher ticket size thresholds, etc. So therefore, development actors should perhaps look at market building as an exercise and enable specialist managers who have the right risk appetite and ability to go and acquire these positions and then work actively to resolve the difficult situations, while also kind of churning capital in the market and keeping the momentum on to attract more and more primary capital in the asset class. I'll just stop here, and then we can cover the rest in the Q&A session.
Thank you all very much for those. We'll start Q&A. Please do continue to send questions in the Q&A. Perhaps we'll start with a question, I guess, around picking up on one of Piyush's last points there around valuations and discounts. and would be interested to get perspectives from perhaps our colleagues in BII and maybe John on any viewpoints or reactions to those comments and how you manage the kind of valuations and discounts in this process.
Okay, I mean, I sort of touched on it briefly in my comments, but I think there's an awful lot of analysis that's in the public domain that demonstrates how TVPI declines, and particularly within, you know, from sort of year 7 or 8 of fund life. And I think the discount is really just the one component you look along on one part of the sort of the jigsaw. You have to look at that alongside your own hold sell analysis and what you think the fundamental realizable value is and when. And you have to look at the implications of that against to what extent you're de-risking your position and the impact it has on your DPI. Now, you know, when you're doing partial exits as well, obviously it's, you know, less of an issue to some extent because, you know, your overall transaction size is smaller and you're not fully exiting the fund, so you've still got an opportunity to ride further upside if it is still there. I am not going to say what discounts we do and don't sell at. You know, our market is too thin to, you know, start putting those figures in the public domain in the way that they are produced, you know, on a highly regular basis for sort of, you know, the developed market secondaries. I mean, you know, less than 1% of global secondaries happen outside of Asia, Europe, and America. And so, you know, comparative pricing is incredibly difficult. So it's the discount is only, yeah, I repeat, the discount is only part of the equation. If we're not comfortable with the realized return that we're taking and the benefit that that gives to the DPI of that fund, we're not going to sell. We're not going to get through our investment committee because we're not doing this for liquidity reasons. We're doing this to see if we can help build the ecosystem, encourage mobilization, as well as a portfolio management tool. But if we're not happy with price and if we're not happy with, therefore, the discount, we won't sell. Now there are structures which can help you close a gap in pricing, you know, deferred consideration or earnouts, and that's something we're increasingly seeing. And that's something that's very common as well in developed markets in lots of LP portfolio sales. But bottom line, if our IC isn't happy with the price and the realized return, we won't do the transaction.
I have a follow-up question on that, but if anybody else wants to come in and comment on that before I ask.
If I may add, while I mentioned about the discounts, I think part of the discounts is just kind of readjusting the valuation to the fair value of asset. And obviously part of it comes through underwriting the assets at the right price to be for the secondary buyer to be able to make a certain return. Because as I mentioned, these are high risk investments, particularly towards the tail end and in slightly more difficult situations. So there is an expectation of a certain return. So I think the discount is a function of two things. One is readjusting the valuation to a more fair value, and then perhaps underwriting for new investors' return as well.
Thank you. And maybe as a follow-up, John, picking up on something you said in your comment about, oh, sorry, Hans-Peter, did you want to come in?
Yeah, I just wanted to mention that discount is also a question of, you know, there's sort of a bit of a circular issue. It's the absence of liquidity, and so if you want to force things into a market that isn't liquid, you end up with discounts. It's also the absence of diversification, and so this is one point that was made in your report, but also here in the presentations, that diversified vehicles, they can actually add value by lowering the risk premium. And so maybe there's a question of design and how the institutions approach these things that is linked to these the issues of discount.
I think just to respond to that, we have done single fund exits, but we normally always do portfolio sales, and we are therefore maximizing the diversification point, across geographies, across sectors, and across vintages, and that is definitely the best way to mitigate against aggressive pricing.
Sorry, thanks all very much for that. John, in your initial answer, you mentioned the kind of challenge with or the inability to publish information and data on this. And one of that is a big challenge in EMDEs and in a lack of data and a lack of information. And wondered if you or anyone else, not to put you entirely on the spot, have any views on how that availability of data can be improved without asking for kind of publication of things that might not be able to publish.
Tempted to plead the fifth and say that it's above my pay grade. Look, I don't know. I think we are in the very early stages of this, right? And I think that we have to be mindful of that. And we're just trying to build the case. And ultimately, we want to ensure that we're creating a win-win situation. And the win-win situation is that we get a good deal, but the buyer gets a good deal. And the buyer has to feel comfortable that they price the assets rightly and that they're realizing the return that is going to help them mobilize from their investors. So I think you've got to allow for a little bit more market traction and market scale, a number of transactions to come through before we start really sort of pointing towards the data. And I know that's kicking the can down the road, but actually, when people start fundraising for these vehicles and start including track record, showing the sorts of deals they'll have done, I mean, the evidence will begin to come out in that way anyway, because they'll have to disclose it in their track records. Maybe not in the public domain, but in the domain of the investor base, for sure.
Thanks for that perspective. I'm going to change tack a little bit here and ask for the speakers from the infrastructure side to talk a little bit more about the potential for a Pan-African or multi-regional infrastructure vehicle and some of the challenges that there might be in creating this multicultural fund and some initial ideas in overcoming some of those challenges.
Ali, I'm happy to start with that. I think it's, and again, we are the opposite end of that spectrum when it comes to mandate. We do have a geographical mandate of sub-Saharan Africa, so I can talk to you about the challenges that we have, and then we can see if that relates to a Pan-African type of fund. The challenge that we see, particularly with institutional investors, is understanding the asset class initially. When infrastructure investment by nature is long term. It spans many years and many election cycles. And when you talk of infrastructure, you talk about country-specific risks. And from that perspective, you gotta have an understanding that when you invest in infrastructure, you got to take a long-term view. You got to have the ability to understand foreign exchange risks, all of those, and local regulatory environments, and most importantly, what is the path to growing to scale? I bring that back again to scale. So it's all well and good having Pan-Africa focus and wanting to grow it. Do you have the pipeline to grow it? Do you have the assets to put into that type of vehicle? That's where we always talk about the enabling environment. Is an enabling environment to attract capital for the investments, or for the assets ultimately that you want to invest in. And again, capital will take the path of least resistance. So the enabling environment is certainly the key element that you need to have a sight of not just existing investments, but also pipeline of future investments. So again, that's my macro view of what will make a Pan-African fund attractive. We bring it back down to our practical position currently. Why did we focus on renewable energy? Because the ingredients for investment in a pipeline of assets within an enabling environment is in place. So you've got significant amount of assets that you can look at. There's a pipeline of assets that will come on stream. The challenge then is matching those assets with long-term investors. And I think the same would apply if you had to look at other sectors where they're not just renewable energy, but other general infrastructure, real asset investments. I'll pause there.
I'm happy to also opine on that, Ali, if it's helpful. And I agree with Ziad. I think scale is a crucial element to consider here. And I think there are several things that you need to consider. And when you look at a secondary vehicle in Africa, I think it will need to be a multi-country vehicle. But I would exclude South Africa and perhaps Egypt, as those are deep and large markets where you perhaps can achieve scale. They're markets, where vehicles can absorb a decent amount of pipeline and have the capital inflow that can match that pipeline. For the rest of Africa, I think to achieve any kind of scale, you will need a multi-country approach, but having said that, I think each country is different. Each country has its own risk, own regulation, own FX movements and challenges. But we have to be cognizant of the type of investors you want to attract. So I think in order to have a decent scale and of pipeline projects, you will need to cover several geographies. But on the other hand, you want to think about what restrictions some investors have. Not all investors can invest in all countries. What domestic exposures and investment limits do they have versus foreign or regional exposures? So I think it makes sense, and it is what kind of we're looking at, but it's not straightforward. I hope that's helpful.
Thank you both. I wonder if I could ask a follow-up question on this to Dave, and actually thinking about from MOBILIST perspectives and focus on listed vehicles. If you think there are opportunities in a potential Pan-African vehicle that might ultimately or initially be listed, and what some of the advantages and challenges of that might be.
Yeah, I think. So I gave an example of one, I suppose. Am I there? Yes, Gaia. But taking an approach that's perhaps a bit nuanced, ambitious, complicated, but that takes into account the relativity of scale according to the markets that you're trying to raise capital in. So, for example, if you're trying to get a listing away in Kenya and you are speaking to fund managers and pension fund trustees there, their concept of what an adequate or reasonable ticket size is in order to participate is not going to be $50 million or the local equivalent. It might be something closer to $1 million, depending on which particular manager you're talking to or trustee you're talking to. And I've actually had several conversations along those lines this week, some of them in the hundreds of thousands of dollars. So if you can conceptually list a vehicle in Kenya or Botswana or Nigeria, in the $20 to $30 million range. Now, it's going to be difficult for the manager to make the economics work at that stage. It's going to be difficult to get sufficient diversification of the assets, but you can get it away just about, which is a totally different. I mean, it's a paradigm shift compared to what would work or wouldn't work in Johannesburg or in an OECD market. And I think this is testament to a couple of things, which is the increasing appetite for and recognition on the part of institutional investors in these markets along the lines of what I mentioned earlier, that they are heavily over-indexed to government paper. which has happened for two reasons. One of which is there are very, very juicy yields to be gotten in your own currency in the government treasuries, and the other one being a lack of product availability. Now, again, this is going beyond the question of Pan-African secondaries vehicles, but it's in the same vein. What we are seeing as products come to market and are presented, there is legitimate interest in supporting them to listing, whether they be infrastructure or otherwise, whether they give regional or Pan-African exposure or simple exposure to the market in question. It feels like there might be a turning point, specifically in Kenya, where we are quite active and hope to see at least a few things get away in the coming months, and Nigeria as well. So yeah, I think scale is relative, and what can work in one market might look entirely different to another.
Ali, I'd also like to come in there. I mean, I talk about scale all the time, but what I sort of mentioned, I don't know if we went in passing in the discussion. From a Rovigo perspective, and specifically renewable energy mandate that we've got, we attempted a listing at a fairly small level, a relatively smaller level, and the learnings we got was you need to be at scale, you need to be big to attract the big money. And we want to attract the bigger money into Africa, and that would mean we need to be listed at some point. And we've set ourselves a target of considering a listing at the $1 billion mark of AUM, which is we've got very good data points for that. We've done a lot of work with advisors in London, and why London? I choose that specifically because you need coverage for this investment class, and you don't have that coverage, specifically asset manager coverage, where you've got sponsors understanding, explaining it to asset managers what this investment class is about, and you get ratings, etc. The difference is for yieldcos within the London market, you've got a lot of coverage for an understanding of yieldcos and infrastructure type investors, and that is something that we as Rovigo obviously would like to eventually tap. Not to say that is the only place that we can list. It is a place that is conducive to a listing, but at a significantly large scale, and then have a secondary listing, on the JSE. And why I say something like that is because you don't have this type of asset class. There aren't any infrastructure type of vehicles such as a yieldco listed on the JSE. So you've got no coverage, you've got no analyst understanding and explaining that within the local market. So let's not reinvent the wheel is what I always tell my team, and myself always. If you've got a market that understands this, then let's use the learnings from that market, use the expertise from that market, but you need to come in at scale, and that's why you need to be bigger to attract the bigger money, and then you have that in-crowding of the local institutions, because then they've got a pricing point that they can use as a benchmark, as opposed to not having full-on information or understanding of that particular investment. I think I'll pause there.
Thank you all. I'm going to change tack a little bit now, maybe time for two more questions. But following what we heard from Piyush at Stratford House and the importance of advisory services with kind of boots on the ground and people in the market, would be interested in perspectives on whether or not, or further perspectives, Sage, you touched on this a bit, on whether or not there's sufficient advisory service market in Africa in particular, and whether there is a need to kind of invest or support the development of this type of market infrastructure on the continent.
Maybe I'll kick us off by just reiterating the point I made earlier. I'm not too sure I can add much to it, other than to say, for us, it is invaluable, and we feel it is a two-way benefit when we engage with investment banks, again, whether it's in Lagos or in Nairobi, where the intermediation of listed vehicles or the capital formation for listed vehicles is one part of a dynamic puzzle that is being put together at the same time. So everything we've been touching on here feeds into itself. The more information you have available, the more investors are going to be interested. The more investors are interested, the more likely investment banks are going to want to hire someone to go and work that particular beat. The more you hire someone to do that, the better networks they create, the more confident investors are going to be. The more confident investors are, the more likely managers are to come to market, and so on and so forth. So intermediation is just one part of that picture, and it shouldn't be forgotten, I guess, is the message I was trying to allude to earlier, and the one I will reiterate here. Because intermediation has, or at least in the financial markets intermediation, as we think of it, whether it's Goldman Sachs in New York or Stanbic in Lagos, is not a space that development finance has historically needed to rely on, because the transacting has been more sort of bespoke or over the counter. But if we are to be serious about using public markets, and if we are to be serious about creating the sort of systemic linkages necessary for institutional capital to be channeled through public markets in ways that don't require a hand on the till from or technical assistance funding or whatever that might look like, then we have a role to play in meaningfully engaging with and giving confidence to the intermediation community so that they themselves can play their role in that dynamic picture that I very ineloquently tried to paint earlier.
Ali, if I can just add, I think there is a transaction size issue here potentially. I mean, a lot of the most established intermediaries that work in secondary transactions, work on large deals for the obvious reason of what that means in terms of, their fee income. And, when you're looking at much smaller transactions, and sort of the transactions we've looked at have, say, ranged between, say, 20 million NAV up to about 80, A, there's a question about would they engage on a much smaller deal? B, do they actually have networks or relationships that are familiar with the space, and so see how much value are they really adding. Now, a lot of the deals we've done, we've cultivated buyers, or had direct sort of approaches and gone into sort of very bespoke, tailored conversations. So I think there is a role for them, and certainly we have used them in markets outside of Africa. Some of them are quite candid and say, look, I don't think we know that market well enough yet. But again, the more activity there is, the more volume there is, I think that will all help, start to stimulate that greater level of interest.
Thanks, John. And just given time, I'm going to close the questions here. I know there were some questions we didn't get to, so if there are any follow-ups, please do feel free to reach out on LinkedIn or via email, which is in the report, and happy to continue the conversation. And with that, I will hand back to Hans-Peter to close the session for us. But thank you, everyone, for attending.
Thank you very much, Ali. And I think on behalf of probably everyone on this call, we can say this is a great report. It's a very timely report. I thought the presentations added a lot of color to it. We now need to see how we can channel this report, which is coming at a time where these kinds of considerations are really quite on the table. How we can channel it into decision-making processes, make sure that it's as influential as it should be. And that's sort of something to think about for MOBILIST, for the FCDO, for BII. I know that BII coming out with a new strategy is very much putting a focus on market creation, which is great. Can we get sort of the broader ecosystem to latch on to this as well? So the clear message is that secondaries in emerging and developing economies are an idea whose time has come. I was very struck by Muru's number there, 400 million flowing into PE, only 200 in exits. You continue for a while, well, you get constipation in this market, and that is just going everything is going to slow down. So it really matters. It impedes the primary flow that I think everybody wants to stimulate. it's very clear that there are a whole range of issues that matter, and your report brings this out very well, as did the discussion. Data matters, sort of the ecosystem of players matters, the policy environment matters, all sorts of enabling conditions, the local institutions, which in the end will have to play a much bigger role than external institutions. So many things matter here. Diversification, scale, standardization, those are the things that always play a role. By the way, I worked at EBRD and I worked at IFC for many years, and we've gone through repeated rounds of trying to sell in the book, especially the infrastructure book, and it was incredibly difficult. And the key constraint really was the lack of standardization, that every project, every investment that these institutions had sort of its bespoke legal and other contractual issues, and it just made everything much harder to sell. So diversification, scale, standardization. It was also clear that there can be virtuous cycles. I think Dave made that point very well, and John again at the end. So you get something, you improve one aspect, something else might follow, which then stimulates the next. How do we get a virtuous cycle going? There are the beginnings of it, and the report is really very good at it. But DFIs, development finance institutions, really matter greatly in that respect. It's sort of the instrument that we have collectively to get things going. And they aren't there today. So in a way, how does one get the DFIs out of their comfort zone? And it's a bit of a comfort zone issue. Yeah, there's mandate, there's other things, but there's a comfort zone issue because in a way, DFIs are not managed by shareholders who want to maximize profit, and therefore the pressure to use their capital as efficiently as possible isn't really there. And they're all well capitalized, and so there's a certain comfort from doing things as they have been done. Turnover of capital is not still not really baked into the culture of these DFIs, and if we want to make progress, we need to get this into their culture. So there's the mandate question. All of them are able to do some element of refinancing. Can we build on that? There's a business model issue. So you have to manage assets for exit when you acquire them. You have to structure them in a way that makes them sellable back down. So that has all sorts of implications for the way the institutions work. It's a big lift. There's the question of scale through collaboration. If you have like one asset in a country and you want to sell, it becomes kind of very difficult. Can you get DFIs to work together? There's the European Development Finance Institutions Group. Can they take a coordinated approach to these things and build vehicles collectively, which then would make so many things much easier? And there is a coordination across. So if we want to work on the broader ecosystem, the enabling environment, can the MDBs be brought in? The World Bank and bilateral public arms that can help to work to create this environment while the DFIs invest in it. That level of coordination has always been incredibly hard to get. There are positive examples, but it's incredibly hard to get. It needs to be baked in. And so with that, I want to also give a shout out to BII and to MOBILIST for pushing this point, putting it on the agenda. Maybe they can help leverage the investor task force. Maybe they can help leverage the UK G20 to get a broader international level of support behind the kind of reforms in the development finance system, especially, that will be needed to make this work. So with that, Ali, thank you very much. Great report, and thank you everyone for staying through to the bitter end.